Last week, a viewer named Walter from Manitoba left a comment that I have not stopped thinking about. He wrote, Linda, I am 64 years old. I worked as a plumbing contractor for 30 years and I own my home outright. Last Tuesday, my accountant mentioned there were new government rules specifically for homeowners over 60 that changed in 2026, and that I should look into them before making any property decisions. He could not explain them in detail because they involve benefit programs, not tax planning. I spent 3 days trying to find everything in one place and could not. Nobody explained it clearly for homeowners in my situation. Not Service Canada, not the CRA, nobody. That comment received over 800 replies from senior homeowners in British Columbia, Alberta, Saskatchewan, Nova Scotia, and New Brunswick, all saying the same thing. Government rules affecting homeowners over 60 had changed. Their CPP, OAS, and GIS could be affected. Not one of them had found a clear explanation of what the new rules were and how owning a home connected to their government benefits. Today, I am giving Walter and every senior homeowner watching exactly that explanation. The new rules for Canadian homeowners over 60 in 2026, what each one means, and exactly how each connects to your CPP, OAS, and GIS in ways most senior homeowners have never had explained clearly. Before I walk you through everything, one critical thing. The next OAS and GIS payment date is approaching, and Service Canada will not send you a personal letter explaining how these homeowner rules affect your specific benefit situation. Subscribe and turn on notifications right now so every time something this financially important comes up, you find out from this channel before a rule change quietly affects your payments. Now let me show you exactly what changed for Canadian homeowners over 60 in 2026. This is not about one small property tax adjustment. It is about a set of rules specifically relevant to Canadian seniors who own their home and whose property decisions connect directly to CPP, OAS, and GIS in ways most people have never had explained together. According to Canada.ca and provincial government published guidelines, Canadian senior homeowners in 2026 are navigating updated federal programs, revised provincial property tax rules, and new CRA reporting requirements that interact with benefit calculations in ways that can either increase or decrease monthly income depending on the decisions they make and the programs they do or do not claim. According to Statistics Canada, the majority of Canadian seniors aged 65 and older own their primary residence, and a significant portion are either approaching major property decisions or missing property-related benefit programs they qualify for because nobody explained the connection between their home and their government income. The first rule every Canadian senior homeowner over 60 needs to understand is the updated principal residence reporting requirement and what it means for your CRA file when you sell or transfer your home. According to CRA's Principal Residence Reporting Guidelines on Canada.ca, every Canadian who sells their primary residence must report the sale on their tax return and designate the property using CRA Form T2091 to claim the principal residence exemption that protects sale profit from capital gains tax. This requirement has applied since 2016, but the 2026 CRA compliance focus has intensified scrutiny on principal residence claims, particularly for seniors who have owned multiple properties, had rental income at any point, or whose ownership period was relatively short. The maximum benefit of correctly claiming the exemption is the complete exclusion of your home sale profit from taxable income, regardless of how large that profit is. The average senior who correctly files T2091 and qualifies for the full exemption pays zero tax on their home sale. Who must file the T2091 includes every Canadian who sold their primary residence in any recent tax year and who has not confirmed with their CRA account that the form was filed. Who faces the most risk includes seniors who sold recently without knowing T2091 was required, because missing this filing can result in a penalty of up to $8,000 and potentially the denial of the full exemption. The critical GIS connection is this. If the exemption is not properly claimed and the home sale profit is treated as taxable income, it appears online 23,600 of your return and flows directly into your GIS calculation through the 50-cent reduction formula, potentially eliminating your GIS entirely for the year following the sale. The second rule is the property tax deferral and reduction programs that most senior homeowners over 60 qualify for, but never apply to because nobody told them these programs existed. According to provincial government pages linked through Canada.ca, most Canadian provinces administer a property tax deferral or reduction program specifically for senior homeowners meeting age and income eligibility criteria. These programs allow eligible seniors to defer annual property tax payment until the property is sold or to receive a reduction based on income thresholds that align closely with the GIS eligibility range. The maximum benefit in provinces offering full deferral eliminates the annual property tax bill entirely for eligible seniors, while the average senior homeowner who applies receives either a full deferral or a meaningful partial reduction. Who qualifies includes senior homeowners age 65 and over whose primary residence is the property in question and whose household income falls within the provincial threshold. Who does not qualify includes seniors whose home is held in a corporate or trust structure, those who own multiple properties, and those who miss the annual application deadline. The GIS connection is direct. The income threshold used by most provincial property tax programs is calculated from the same net income figure on your CRA return that Service Canada uses for GIS, meaning if you qualify for GIS, you are almost certainly also below the property tax program income threshold in your province. Third, and this connects most directly to both your OAS and GIS together, is the home accessibility tax credit and how claiming it correctly produces a chain reaction through your GIS calculation that most seniors miss entirely. According to CRA's home accessibility tax credit pages on Canada.ca, Canadian seniors aged 65 and older who incur eligible renovation expenses to improve safety and accessibility of their primary residence can claim a non-refundable tax credit on those expenses up to a confirmed maximum annual amount per Canada.ca. Eligible renovations include grab bars, wheelchair ramps, widened doorways, walk-in tubs, and modifications designed to reduce fall risk and improve mobility. Here is the insider knowledge moment most seniors never hear explained anywhere else. Claiming the home accessibility credit reduces your net taxable income online, $23,600 through the interaction of deductions and credits on your overall tax calculation. Lower net income online $23,600 means higher GIS entitlement through the 50-cent reduction formula. A senior who claims eligible home accessibility renovations in 2026 may receive not just a tax credit reducing what they owe the CRA, but also a higher GIS payment the following July because their net income dropped to a more favorable point on the GIS reduction scale. Two separate financial benefits from one renovation claim. Canadians who work with retirement financial planners have this double benefit identified automatically when any eligible renovation claim appears. Most Canadian seniors on CPP, OAS, and GIS find out about the GIS connection only after the July recalculation, without anyone explaining why their payment changed. Now you know to expect the improvement and plan your renovation claims to maximize the combined effect on your tax bill and your GIS simultaneously. The fourth rule is the post-sale investment income planning issue that affects seniors who sell their home and invest the proceeds without understanding how the resulting investment income connects to their OAS. The home sale profit itself is not taxable income if the principal residence exemption is correctly claimed. However, what you do with that money after the sale can create taxable income in following years. Seniors who sell their home and invest the proceeds in interest-bearing savings, dividend-paying investments, or registered accounts generating taxable withdrawals are creating new income sources that flow into their net income calculation and can push them above the OAS clawback threshold confirmed on Canada.ca. A senior who sells their home for a significant amount, invests the proceeds, and generates modest annual investment income may find that income is enough to trigger the OAS clawback in the years following the sale, even though the sale itself was completely tax-free. Understanding this issue before you sell determines whether your home sale leaves your OAS intact or creates a years-long clawback from investment income you did not anticipate would matter. Now here is the connection most coverage misses completely. The principal residence reporting requirement, the property tax deferral program, the home accessibility credit, and the post-sale investment income issue all connect through the same net income figure on your CRA return and the same Service Canada file. Filing T2091 correctly keeps your home sale profit offline $23,600 and protects your GIS. Claiming the property tax deferral reduces monthly housing costs without affecting GIS since property tax is not income. Claiming the home accessibility credit lowers your line $23,600 figure and improves GIS simultaneously with the tax credit benefit. Managing investment income from home sale proceeds carefully keeps total net income below the OAS clawback threshold after the sale. 4 separate homeowner issues, 1 income figure, 1 file. Getting all 4 right or wrong determines whether your home works for your retirement income or quietly against it. Walter from Manitoba did not know about any of these connections when his accountant mentioned the new rules. He knew property decisions had benefit implications. He did not know exactly which ones or how they connected through the same income figure to his CPP, OAS, and GIS simultaneously. Walter contacted a CVITP volunteer and a Service Canada representative in the same week after leaving his comment. He confirmed his province's property tax deferral program was available based on his projected retirement income and noted the annual application deadline. He learned about the home accessibility credit for a bathroom renovation he had been planning and understood for the first time that the renovation would produce both a tax credit and a GIS improvement the following July. And he understood the post-sale income planning issue clearly enough to know that when he eventually sells, he will need to structure how the proceeds are invested to avoid OAS clawback income in retirement. Walter told me the conversations he had in that 1 week gave him more practical clarity about how his home connected to his retirement income than 3 years of reading government websites had produced. So here are 3 steps you can complete this week. Step 1, log into your CRA My account at canada.ca/en/revenue-agency and confirm that Form T2091 was filed with your tax return for any year in which you sold a property you claimed as your principal residence. If any sale was not reported with a T2091, contact the CRA at 1-800-387-1193 immediately to discuss filing the form. Late and protecting your exemption before a compliance review identifies the missing filing. Step 2, contact your provincial property tax authority and ask specifically whether a senior homeowner property tax deferral or reduction program is available in your province, and whether you meet the age and income criteria to apply before this year's deadline. Step 3, if you have made or are planning any home accessibility renovations in 2026, confirm with the CVITP at 1-800-959-8281 that the home accessibility tax credit will be claimed on your return for the year the expenses were incurred, and ask specifically how the credit will interact with your net income and your GIS calculation the following July. One important warning: scammers are targeting Canadian senior homeowners with calls claiming to be from the CRA or provincial programs offering to help claim property tax refunds or renovation credits for a processing fee. This is a scam. Every program described in this video is free to apply for directly. The CRA will never demand immediate payment by phone or ask for gift cards. Hang up immediately and report it to the Canadian Anti-Fraud Center at 1-888-4958-501. Are you a Canadian homeowner over 60? And did you know before watching this video that your home ownership decisions connect directly to your GIS calculation, your OAS clawback situation, and your provincial property tax eligibility all through the same income figure on your CRA return? Drop your province and whether you own your home outright or are still carrying a mortgage in the comments, because I want to understand how many senior homeowners are making property decisions completely separately from the benefit consequences those decisions produce. What we covered today is confirmed, and these rules apply right now to every Canadian homeowner over 60 in 2026. More property and benefit related updates are scheduled before the end of this year, and Service Canada will not send you a personal explanation of how your home connects to your CPP, OAS, and GIS. Subscribe now so that information reaches you before a property decision you make this year creates a benefit consequence you did not see coming. You spent your entire working life building what you have, including the home you live in. Make sure your home is working for your retirement income and not quietly against it. I am Canada Seniors Update, and I will see you in the next one. Take care of yourself.